You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. Okay, imagine you're navigating a critical route and suddenly your main GPS signal just vanishes.
Right.
That's pretty much the spot global markets are in today. So our mission is to understand how markets actually work and, what they start valuing when a huge piece is missing.
And that piece is the big one. The U.S. jobs report, the non-farm payrolls, it's off the table because of the government shutdown.
Oh, exactly.
And, that absence isn't just a blank spot on the calendar. It removes, the key fundamental truth teller for the U.S. economy, doesn't it?
It really does.
So when data that big gets pulled, markets don't just stop, they pivot instantly.
Pivot to what, though?
The tone gets set by, say, central bank guidance, whatever the latest trade headlines are, and maybe most sharply, by every little twitch in geopolitics.
Right. So we're diving into those substitutes today. The indicators stepping in, the extra importance of what central bankers are saying, and the geopolitical stuff filling that data void.
We need to map how the market's making its own internal compass right now.
Okay, let's start there. What is the market reading when the jobs numbers just aren't there? The non-farm payrolls, it's usually the biggest release of the month, the best signal for economic health, for what the Fed might do next. With that gone, what are traders immediately looking at instead? We're hearing PMIs, ISM. Can you unpack those a bit?
Sure. Well, since we can't look back at the jobs picture, everyone has to lean on forward-looking stuff. Sentiment, basically.
Okay.
So the immediate substitutes are these preliminary U.S. PMIs, that's Purchasing Managers Indices, and the ISM Services print, Institute for Supply Management Data.
And what do they tell us?
They give you a sense of what businesses, specifically the purchasing managers, are planning for next month. Hiring, spending, inventories. It's like a forecast, trying to replace that historical snapshot the jobs report gives.
But that still feels partial, doesn't it? Especially for an economy as massive as the U.S.
Oh, absolutely. It's a partial view. And because these substitutes aren't, the full picture, that's precisely why any scheduled remarks from central banks, the ECB, the Fed, the Bank of England, suddenly carry what our sources are calling extra weight.
Extra weight.
Yeah, like exponentially more weight. Traders don't have their usual hard data input, so every word from policymakers gets magnified.
And you can sort of see that uncertainty reflected in the dollar, right? It's generally softer, kind of stuck in a tight, nervous range.
Exactly. It reflects the confusion.
But here's where it gets tricky, where policy talk seems to clash with the market. The yen. You'd think, okay, geopolitical risk is up, U.S. data is uncertain, money should pile into the safe haven yen. So why is it the notable laggard?
Yes, the yen paradox. Usually it would strengthen, but this time Bank of Japan Governor Ueda, he stepped in and was incredibly clear in his public comments.
What does he say?
He really hammered home the need to keep an accommodative stance. That's just jargon for keeping rates low, keeping policy loose, to support the Japanese economy.
So his word basically overrode the usual safe haven instinct.
Pretty much, yeah. That strong commitment to easy money kept the USD-JPY pair on the front foot, meaning buyers were pushing it up, even while the dollar was soft elsewhere.
Wow.
And that policy stance is even more powerful right now because everyone's watching the upcoming LDP leadership vote in Japan. So the promise of policy continuity, it just trumped the stress from the data vacuum.
Okay, let's stick with that theme, policy trumping data, and look at sterling, because this is another one that makes you go, huh?
The pound is actually up a bit.
Yeah, just a touch higher.
Which feels totally backward, given the UK services PMI was just revised down. Bad services data should normally hit the currency, right? So what's stopping the sell-off?
Right, it should hurt it. But the reason, it seems to be a kind of structural policy traffic jam, not about economic strength.
Just traffic jam.
Yeah, reports suggest many big UK companies are basically putting major decisions, major investments on hold until after the government reveals its autumn budget.
So they're just waiting.
Yeah.
Sitting on their hands. Exactly, waiting for clarity from Westminster. And if the big economic players are frozen like that, waiting on tax or spending news, then yesterday's PMI revision. It almost doesn't matter in the short term.
Interesting.
The market isn't trading yesterday's news because they expect policy months down the line to be the real driver. It's a pause, kind of insulating the currency from immediate bad data, ironically.
That is fascinating. So policy anticipation creates a temporary shield. Okay, let's quickly run through the rest of the currency board.
Sure. The euro is modestly firmer. Its final PMI revisions came in mixed but mostly unchanged. And then if you look at the antipodes,
The Aussie and Kiwi dollars?
right, the Australian and New Zealand dollars, they're also slightly firmer. They seem to be getting a lift from, well, slightly better global risk sentiment overall, and also, importantly, the continued strength we're seeing in base metals.
Okay, perfect segue into commodities then. Gold seemed to be pausing, waiting for that U.S. services data we mentioned earlier.
Yeah, holding its breath a bit.
And crude oil showing just how sensitive it is to geopolitics, even if the reaction was short-lived.
Very sensitive. It popped up briefly when a Hamas official mentioned needing more time to discuss the U.S. Gaza plan. Any hint of delay means supply risk, right? But that bid vanished pretty quick. The real story in commodities today, I think, is in the industrial metals. Base metals are still underpinned, as they say.
And copper's the standout there. It pushed higher towards, what, USD 10,850 a ton. That's a decent move.
It is. Copper is definitely leading the charge.
So what's behind that copper strength specifically?
It's a mix of things, really. First, the generally weaker dollar makes copper cheaper for buyers using other currencies. That helps.
Standard commodity logic.
Yep. Second, there are ongoing supply issues. Production's still tight in places. But maybe the bigger picture is copper acting as that barometer for global industry.
Ah, Dr. Copper.
Exactly. Its strength suggests that despite all this political noise and uncertainty, investors still have some underlying faith in long-term industrial demand. That's helping pull the whole complex and currencies like the Aussie and Kiwi along with it.
Okay, and this is where that shutdown impact really bites, isn't it?
Yeah.
With key U.S. data delayed, policy signals, government decisions, they're getting what sources call added market attention.
Absolutely. The market is basically hanging on every word out of Washington now. Policy talk is the new economic indicator, for lack of a better term.
So what specific policies are getting priced in?
Well, the market's trying to figure out potential fiscal stimulus. There's been intense focus on two ideas linked to tariffs. First, talk that the president is considering taxpayer rebates, maybe $1,000 to $2,000 per person.
Funded by tariffs.
Funded entirely by existing tariff revenue, yeah. And second, the administration seems to be prepping cash support for farmers using money they already have, but there's also talk of more aid linked to tariffs down the line.
Okay, so when traders try to price this in, what does that actually mean for the market's view of the economy?
It means they start boosting their expectations for future consumer spending. That $1,000 or $2,000, that's potential fuel for retail, for travel, for services.
Right.
So even though the funding source is tied to trade friction, which is its own uncertainty, the market latches on to the potential near-term cash boost. It nudges up expectations for demand, maybe inflation too. It's a key driver when the normal data signals are dark.
And this focus on trade friction, it's clearly not just a U.S. thing, it's global.
Oh, definitely not. We should note, for example, China just launched its own trade probe into Mexico's tariffs, and Beijing signaled it would, quote, take necessary steps to protect its companies.
So it becomes a chain reaction.
It illustrates how one country's policy move like a shutdown delaying data can ripple out, forcing global players to focus more on protectionism everywhere else, because that's where the reliable action or volatility is coming from.
And this shift in attention, it ramps up focus on geopolitical hotspots too, doesn't it? They're not just background noise anymore. They're actively setting the tone right alongside what the central banks say.
You really are front and center. Let's tick through the main ones markets are watching.
Okay.
First, the Middle East. Hamas told mediators they need more time, want changes to the U.S. Gaza plan. That stalls any immediate hope for de-escalation the market wants.
Keeps the risk premium on oil, keeps things tense.
Exactly. Maintains volatility there. Then in Europe, we saw actual physical disruption overnight.
The Munich airport incident.
Yeah, briefly closed due to drone sightings. It reopened. But even a short, unpredictable event like that adds an immediate risk premium. You see traders watching aviation stocks, European futures. It highlights infrastructure vulnerability, triggers quick, even if temporary risk-off moves.
Right. And finally, the Russia-Ukraine situation. President Putin issued some very specific, high-stakes warnings.
He did. He said any seizure of vessels raises the risk of confrontation at sea. That immediately impacts things like maritime insurance, shipping stocks in that whole region.
And the missiles.
Yes, he addressed potential U.S. supplies of Tomahawk missiles to Ukraine, calling it dangerous and an escalation. Now, when a leader explicitly links specific weapons to dangerous escalation, the market doesn't just hear political talk.
How does it process that?
It processes it as potential for increased defense spending globally, maybe continued energy volatility, heightened general risk. The market has to digest all this increased political risk when the usual economic bedrock data just isn't there. It's silent. Hashtag tag outro.
So wrapping this up, what does this all mean for you, the listener? I think the key takeaway for navigating these pretty unusual conditions is this. The second the non-farm payrolls disappeared, the market's compass needle swung hard towards policy.
Definitely. We flipped from data-driven to policy-driven.
Almost overnight. Yeah, so policy signals, whether it's central bank comments, talk about tariff-funded checks, or these geopolitical threats, they're acting as the main proxies now for economic health and stability.
So this deep dive hopefully gives you a kind of structural map for how markets behave in this state of vacuum. Moving forward, you really need to keep an eye on a few key things.
What's the watch list?
Okay, first, the actual ISM Services report when it lands. That's the immediate potential market mover. Second, keep tracking the policy debate in the U.S., those tariff rebates, farmer aid. Third, obviously, how long this U.S. shutdown actually lasts. And fourth, the negotiations over the Gaza plan. Those are the immediate sentiment drivers.
It feels like the market isn't waiting for economic facts anymore. It's reacting to political noise. And political noise is just inherently less predictable than data, isn't it?
It really is. And that brings up a bigger question, maybe something for you to chew on after this. When political events, shutdowns, explicit warnings between nations when they become the main market movers because the normal flow of economic data is cut off, what does that tell us fundamentally about how fragile global sentiment might be right now? How much more volatility does that shift introduce?
Yeah.
Moving from slow burn data to sudden high-stakes headlines, the market's basically trying to price political risk in real time, and, well, that's a very tricky game.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.